Today, we are diving into a really cool and, honestly, a deceptively simple investing strategy. It's one that completely flips a core belief of modern finance on its head. The basic idea is, what if the secret to crushing the market was just to buy the winners and sell the losers?
So let's start with that question. Think about it. What if all the complicated charts, the deep dive financial reports, the constant hunt for that one hidden gem, what if you could just skip all of that with this surprisingly straightforward, almost mechanical rule?
Well, back in 1993, two researchers, Narasimhan Jegadeesh and Titman, dropped a paper that sent some serious shockwaves to the financial world. They laid out a strategy that seemed to do the impossible, and in doing so, they really questioned the whole idea of a perfectly efficient market.
Now, to really get why their findings were such a bombshell, you have to understand what everyone thought they knew at the time, the playbook that most investors were following. Back then, you basically had two big ideas battling it out. On one side, you had the underdog comeback crew. This was the mainstream view, the contrarian strategy. The idea was simple: buy stocks that have gotten beaten up because they're probably going to bounce back. But on the other side, you had the hot hand idea, what we now call momentum investing, and that says no, bet on the winners, assume they're going to keep on winning.
And, the buy the losers camp had some serious academic weight behind it. Big-time research, like this famous paper from DeBont and Thaler, argued that investors are just, they're emotional. We overreact to bad news, we panic, and we push stock prices way too low. And that creates a perfect opportunity, or so the thinking went, to jump in and scoop up those loser stocks for cheap.
So with that as the backdrop, Jegadeesh and Titman decided to really put the other idea, the hot hand, to the test. They set up an experiment based on a super simple, totally mechanical strategy. Here's the playbook. Step 1. Every single month, you rank all the stocks based on how they've done over the past few months. Step 2, you build a portfolio by just buying the top 10%, the winners. Step 3, at the same time, you short sell the bottom 10%, the losers. And then step 4, you just hold on for a few months and then you do it all over again. The key thing here is that it's all automatic. No gut feelings, no fancy analysis, just letting the numbers make every single call.
So they took this strategy and ran it on decades of market data, all the way from 1965 to 1989. And the results? Well, let's just say surprising doesn't even begin to cover it.
So this is the big question, right? After all that, did this incredibly simple strategy actually work?
And the answer was a massive, resounding yes. The best version of their strategy pulled in an average profit of 1.49% per month. Now, I know that might not sound like a huge number, but trust me, in the world of finance, that is an insane, ridiculously consistent return. That works out to over 19% a year compounded. And remember, this came from a simple rule that pretty much anyone could follow.
Okay, when you see a number like that, the first thing you have to ask is, why? If it's really this easy, why does it work? There's got to be a catch, right?
The first place your mind goes in finance is always risk. The only way to get high returns is to take on higher risk. So, were these winner stocks just way more dangerous than the losers? And was this big profit just the payment for taking that gamble? But when the researchers actually looked at the data, what they found was the complete opposite of what you'd expect. They measured risk using this thing called beta. It just tells you how much a stock swings around compared to the whole market. And get this, the loser stocks actually had a higher beta, which means they were the riskier bet. The winners were actually less risky. And the whole strategy combined, it had a slightly negative beta, meaning it was basically shielded from the market's big swings.
So this is the really crucial point. That whole risk explanation was a total dead end. The strategy wasn't making more money because it was riskier. In fact, it was a little bit safer than the market, which, of course, just made the whole thing even more of a mystery. If it's not risk, then what on earth is going on here?
So the paper's big conclusion was a huge challenge to the idea of a perfectly efficient market. They argued that these profits were coming from something they called underreaction. Basically, the market is just slow. When good news about a company comes out, the stock price doesn't instantly jump to where it should be. Instead, it kind of drifts up over time. Same thing with bad news, it drifts down. This whole momentum strategy was just taking advantage of that predictable, lazy drift.
But wait, the story doesn't end there. Like any good detective story, when the researchers dug deeper, they found a few really weird quirks and twists in the data. So the first twist is a really strange one. For some bizarre reason, this strategy that was winning all year long consistently lost a ton of money in one very specific month, January. As you can see, the other 11 months of the year, it was printing money. But come January, boom, it would just crash. It's this weird seasonal thing that people are still debating today.
And that weird monthly pattern wasn't the only thing they found. The second twist is that the hot hand eventually goes cold. This momentum effect is powerful, for sure, but it doesn't last forever. The profits are really strong for that first year. But after that, the whole trend starts to go in reverse. Yesterday's winners start to fall behind. And yesterday's losers, those underdogs, they finally start to make a comeback.
And this timeline here shows you that whole life cycle perfectly. You see the profits peak right around the 12-month mark, at about 9.5%. But then the decay sets in. By month 24, more than half of those gains are just gone. And by the end of year 3, you're left with only a tiny slice of that initial profit. So it seems like the magic has an expiration date. So, what's the big takeaway from all this? Well, it's that the market isn't always this perfectly logical, super efficient machine we sometimes think it is. Sometimes it's predictably slow, and simple rules can actually find an edge, which leaves us with one last really fascinating question to think about. If a pattern this powerful was just hiding there in plain sight for decades, what else might we be missing?